Welcome back, guys. Today we're going to analyze Paycom software. Now, there might be something that I'm missing about this stock because it seems to be unduly punished. Over the past 5 years, it's down 33%. However, their fundamentals have always continued to improve. So I'm not quite sure why they've been punished so much. They are a $8 billion company, so kind of small, and they definitely have room to grow. Their price to earnings ratio is 17, so it seems like a fair price to earnings ratio. But then you come to their growth and you just look at this growth. They went from 737 million all the way up to 1.7 billion in the revenue. So that growth has been very, very good. And their profit margins have been very strong as well, around 20% each and every year. And especially last quarter, it jumped all the way up to 50%. I'm not quite sure if that's a fluke or not, but in their financial statement, this has happened because they cut cost, at least according to the numbers. And what does Paycom do? Well, they do payroll services and HR and hiring and stuff for small and medium-sized businesses, pretty much. And yeah, I'm not quite sure why they've been punished. Maybe there's some competition coming in, or maybe people are worried about AI. I'm not quite sure how that's going to affect it. I definitely think that um, HR services and payment services for companies is definitely protected. Like it's not going to go away anytime soon. Their statements, we can see their revenue growth has been stellar, about 20% every single year, except for the last quarter, it was only up 10%. So maybe that's what the investors are worried about is this slowing growth of 10%, but it's still growing, so it's not negative at least. And their margins have improved. They actually cut a lot of costs. You can see their operating cost right here has gone down by 100 million when it was 200 million last quarter. And they basically cut all of their costs in their selling and general administration expenses. So they must have laid off a bunch of people. At least that's what I'm guessing. So maybe that's why, or maybe they stopped marketing so much. That could also be a possibility. But that's probably why their margins expanded a lot. I'm not quite sure if that's a fluke, if that's going to go back up or not. So with my margins, I'm being quite conservative. In terms of their balance sheet is solid. They have no debt. They have negative net debt, so very good balance sheet. Their cash flow statement, they decided they're going to buy back some stock. So I'm guessing they're going to buy back some stock again in 2024. And then they also pay a bit of a dividend now. So they are returning cash to shareholders, which is good to see. Their stats, we can check out their margins here. Their return on invested capital is very high, so very good to see that. And their gross margin very high, and their net margin at about 20%. However, last quarter, once again, 50%, which is pretty crazy to say the least. Taking a look at what the analysts are projecting, the analysts are even projecting growth. This is according to 20 analysts. They're projecting earnings growth and they're projecting revenue growth, 10% this year and reaccelerating up to 12% next year. So pretty good growth there. In terms of their stats, now this is where I'm seeing a little bit of a red flag, I guess. Their short percentage at 3.5%. That seems a bit high for a company that is growing and with such a low price to earnings ratio right now. However, still, this isn't too bad. It's not like above 10 or something, so it's not so bad. I would say that even with because this company has been downtrending, 3.5% really isn't that bad for a company with that type of chart. Let's take a look at the model I have. Now I put the estimates here, I put the buybacks there. Net debt, negative 370 million, discount rate 10% because I want a 10% return on all my stocks. Exit multiple 18, they're currently trading at 17. I think 18 is totally fair for this company. It's kind of a competitive industry. I'm sure that their growth might slow down a little bit. I think 18% is totally fair. In terms of growth, I have their earnings growth at only 8%. Which historically this is low. They've been growing much faster than this. And even with this low growth estimate, we're looking at a fair share price of $163 a share. And with the revenue margins, I have the revenue growth at 10%, and they're projecting a profit margin of 24% this year. And I have it going back to their historical average of 20%. It definitely could go higher than this because last quarter was 50%, and that's because they cut cost. So their profit margin could be higher at maybe like 30%, and they could definitely get it up higher. But this is kind of a conservative estimate, I think, and their fair share price comes out to 147. Now, if we wanted to be more bullish with this company, we could definitely say that their profit margin is going to expand up to 30%, which is definitely possible based on their last quarter. And then we could even say that their growth continues to be quite strong at 12%. And then we could even say that their exit multiple would be a little bit higher at 22. Now, if we had these like very bullish estimates, then the fair share price would be at almost $300 a share. And yeah, with them currently trading at 143, they're way underpriced. Now, I'm not quite sure if this is going to play out or not, but definitely could. It's definitely possible based on their historical growth. And were they ever at $300 a share? Yeah, back here they were all the way up at $550 a share, so definitely way overpriced at that moment. And they were trading at $300 a share not even that long ago, but now they're trading at 143, and definitely probably a good price to buy the stock at. So yeah, that's my opinion on Paycom. Let me know what you guys think in the comments. Let me know if I missed something, because it definitely seems like I might have missed something. And yeah, leave a like. I'll see you in the next video.